Hello, I'm Juliet Sarli. In this week's edition of IG Macro Intelligence, we take a deep dive into the implications of Trump's tariffs and how to protect your capital amidst the uncertainty. Global markets have been in free fall amid the uncertainty caused by the Trump administration's tariffs and fears of an all-out retaliatory trade war with China. AMP chief economist Shane Oliver thinks the tariffs could cause global markets to correct by around 15%, but points out that while the fall in US shares has been rapid, the total drop is mild compared to the last 120 years. Meanwhile, former Treasury Secretary Larry Summers has warned there could be much more volatility ahead for global investors, advising caution in a post on X. In the wake of the tariff turmoil, JP Morgan has revised down its growth forecast for the US, suggesting a 0.3% contraction in the world's largest economy throughout 2025. Barclays economists predicting recessions in both the US and Europe due to the tariffs, while they've lowered their growth forecast for China to 4%. Locally, the impact of the tariffs on the Australian economy are being felt not only in the stock market, but in predicted longer-term pain for growth.
I think the problem at the moment for the market is it's not bad to actually say we just don't know what the outcome might be. Now, if things did settle down, do we think that slightly higher inflation, slightly lower growth is commensurate with sort of 10% declines in equity markets? We can kind of think that that's probably not too out of whack. But the problem is that if it actually does intensify from here, and we don't know, Trump is probably the only one who knows that, then our market's priced for further declines in growth and further declines in confidence.
In the days after the tariffs came into effect, ANZ changed its rate cut forecast, suggesting the RBA will now deliver 3 more quarter-point cuts by August. Economists at ANZ also not ruling out a jumbo 50 basis point cut when Australia's central bank meets next month. And Deutsche Bank's Phil O'Donoghue agrees. So have you changed your view in terms of what we see from the RBA?
Yeah, look, I have. I think we're going to see a 50 basis point cut now from the RBA at its upcoming meeting in May. I was previously looking for a 25 basis point cut, but these tariffs, unless we see the administration pivot to an off ramp within days, the scale of the disruption to global markets, as indicated by financial market volatility over the past couple of days, that I think overwhelms the domestic considerations in front of the RBA.
Well, meanwhile, the Federal Treasury Department has modelled the likely effect of the tariffs, expecting they'll deliver just a modest 0.2% hit to GDP this year and just 0.1% by 2030. Gold prices initially hit fresh records amid the volatility before easing amid a broad-based sell-off. US debt has rallied amid expectations the US Federal Reserve will aggressively cut interest rates to avoid a recession. Government bonds have been a haven trade more globally as well, with Jonathan Sheridan from FIG Securities telling Ausbiz the correlation that bonds and equities had for 20 years, which broke down during the COVID-19 pandemic, has now re-established.
The broad expectation is that this is going to be sort of a net negative for global trade. The other thing is that tariffs have been previously thought to be inflationary, which is on the other side of that coin. So if the global economy is slowing, then you'd expect bond yields to fall. And if inflation is going to keep going or possibly increase with the tariffs, then you'd expect bond yields to rise because they do that to keep a better relative return compared to inflation. So it's a bit of a tricky one. I think what you find is that risk-free bonds, so large developed government bonds, will probably do relatively well at the short end because central banks will look to continue their rate cutting cycle.
Well, when it comes to stock specifics, defensive plays have been in action, with John Lockton from Sandstone Insight saying capital preservation is key.
You're bullish on wanting to take a short-term bounce through to stocks with markets go sideways through to those more defensive stocks. So, names like IAG, strangely enough to me, look reasonably defensive.
Right.
Coles, your Telstras, your Transurbans, those kind of stocks in this environment, that's capital preservation first.
So what to buy when stocks are on sale? Elise McKay from Pendal reckons Australia is still a relatively safe place to put your capital.
I think there's opportunity really in those industrial-focused domestics, which should be much more protected from some of the issues that we're seeing globally. And then there's other companies with other characteristics. So, for example, we really like companies that have capital, so they're returning capital to shareholders, companies with buybacks. If you can be out there buying back your own stock down 6% plus today, I mean, that is a great opportunity if you think your stock is undervalued. And there's certainly many stocks today out there which are undervalued. The likes of Worley, for example, that's off 12% so far this morning. They've got a buyback in place. They're only 6% of the way through it, and they can buy back hundreds of millions of dollars more of their stock. So we like those with buybacks.
Scott Phillips from the Motley Fool likes Brickworks, which currently have an average target price of $28.30 according to Refinitiv, suggesting it can rally a further 20%. Philip Pepe from Shaw and Partners says during the Orange Swan event, you should consider looking at Acrow. He's got a price target of $1.30 on the stock. And Acrow, he says, is in an industry with very low, if any, exposure to global trade. And analysts at Jefferies have singled out lotteries as a defensive category with minimal exposure, they say, to tariff fear, suggesting the Lottery Corporation can execute on growth strategy. And that is your IG macro intelligence for this week. We'll see you next week.